All right, now for the question from today. This comes directly from our audience. This is where we get all our questions from. So this person has a question on Roth 457s, or Roth deferred compensation plans, as you guys call them. So as you guys know, Roth deferred compensation plans in general, or 457 plans, as soon as you separate service, you're able to draw them out with no 10% penalty, right? So if you separate service at 36 and want to withdraw funds, you can withdraw funds, you're going to pay taxes, but there's no 10% penalty. So the question is, does all these rules still apply to a Roth DCP or Roth 457 plan? Can I still draw my money out ahead of time with no 10% penalty? And the answer is yes, but you might owe taxes on it still. So the whole point of Roth just means I'm paying my taxes now to don't tax me later. Right? So if I put all my money in and I'm paying taxes as I go, the benefit is the interest over time that grows is 100% mine. It's tax free. So if I do put $30,000 in and the account grows to $60,000, I could theoretically withdraw $60,000 in Roth and it's all tax free. If I did that on the pre-tax side, I put $30,000 in and it grew to $30,000, I owe taxes on $60,000 because I ain't paying taxes yet. So as far as the way the Roth deferred compensation plan works, once you separate service, you're allowed to withdraw your own contributions first. The contributions in a Roth is money that you've already put in and already paid taxes on. So that money can come out right away. There's no tax hit on it. However, the growth in it, so any interest you've earned inside that account, the growth is under a separate rule. It still cannot be drawn before 59 and a half or before the account is at least 5 years old without having to pay taxes on it. So there's no 10% penalty. That rule still applies to deferred comp, but you can still owe taxes on the growth. Even though it is a Roth has stipulations. Not all the growth is automatically tax-free. It's only tax-free if the account is at least 5 years old and you have to be over 59 and a half. So if you separate at age 60 and you only had deferred comp for 1 year, you haven't met the 5-year rule yet. That growth is still considered taxable. You gotta wait 4 more years. If you separate at 50 and you've been doing the Roth your entire career, you've got the 5-year rule met pretty easily, but you're not 59 and a half yet. You still have to pay taxes on the growth. When it comes to withdrawing money from the Roth, there's a sequence that it comes out in. So the sequence that they follow is it's going to be coming from your contributions first, then they take money from any rollovers you made, or if you did any type of Roth conversions, that's second in line. Lastly is going to be your growth or your interest on it. So for example, let's say I put $40,000 of my own money in this Roth deferred compensation plan. And then I had $10,000 in another Roth account somewhere else, old employer, and I moved that in. Now I have $50,000 in there. $40,000 from my own contributions, $10,000 from the rollover. Now let's say the interest earned inside this account was another $20,000. So now my account is worth $70,000 in total. So I look at my account statement, great, I got $70,000. I separate service. Let's say I'm 52, for example, and I'd say I want $60,000 to go buy something. So I take $60,000 out. How is that going to affect me from a tax standpoint? So it goes through that order. So they say, okay, how much did he add in contributions? $40,000. So I need 60. 40,000 is going to come out of the contribution side. That's 100% tax free. So I don't pay any taxes on that 40,000. Next in line is going to be that rollover conversion section. I got 10,000 there. Great. So that 10,000 comes out. It's a rollover. It already was a Roth. Therefore, that's tax free too. Next line down, interest earned. I had $20,000 interest earned. I need an extra $10,000 to fill my $60,000 sell order. That $10,000 that I had to take from the interest, because I'm not 59 and a half yet, I got to pay taxes on that money. No 10% penalty, just the taxes. So on that $60,000 withdrawal, only 10,000 of it is actually going to be subject to taxes. And as far as, what rate, it depends on your tax bracket. So it's whatever bracket you're falling at that time. Keep in mind that Roth that you took out, the 50,000 of it that was tax-free, does not count as income. Even though you got money out of the account, it's not count as income, or at least taxable income to you. So if you had a job that year and you said you earned $100,000 that year, and then you pulled this $60,000 out of the account, you would report income for the $100,000 you're like normal, and you'd have a distribution of $10,000, from the Roth account. Therefore, you would report income of 110, and you'd pay taxes as you earned 110. Right, so there's no special tax rule that applies to it. It's not some higher arbitrary rate. It just goes on your income statement, and it's whatever bracket you fall into. Now you look at that 110, then you take off all your standard deductions, so you'll be under 100. If you're married filing jointly, that's usually the 12% bracket range. So of that $10,000 you took out, you would pay essentially 12% tax on it. It would be about $1,200 in this scenario. So Roth 403Bs, still carry the same rule that you can pull money out at any time with no penalty, but that only applies to your contributions. It does not apply to the growth. Now, I said conversions in there. Conversions also have their own little rules. It can be a little tricky if you have a conversion instead of a rollover. Roth conversions actually have their own separate 5-year rule that you have to fulfill before that's actually considered tax-free. So it's a lot to keep track of. That's also why you guys pay record-keeping fees inside your deferred compensation accounts. It's to keep track of all those tabs and all the tax liabilities you might face. All right, so if that was helpful for you guys, you want more information on this type of Roth deferred compensation stuff, we want to dive deeper into your benefits and the best ways to utilize them. The link in the description of the show notes below is going to be to our free community. I've got a free training on there on all of your amazing benefits. Plus, I go live once a month to field calls in person. Plus, I got a whole library of different resources and calculators available for you guys. So it's free to join. Click the link and I'll see you guys there. And until next time, remember that your future depends on what you do today.